Good morning, everyone. Really happy that we had such a wonderful turnout on this great June day. As Tom said, we've been running these business roundtables now for about the past 4 years or so, and we've had quite a great mix of talks within the whole spectrum of analytics. And today is no exception. We're going from performance management to marketing optimization to mobile computing. So we're kind of looking at a pretty wide band throughout the whole field of analytics. Just a couple of things, just so you know that at the Villanova School of Business, we had been at a situation where we had an interim dean because our previous dean, Jim Danko, accepted the presidency of Butler University about a year ago. And we're pleased to announce that we now have a permanent dean, Dr. Patrick Mjidi. And I think it bodes well for us. Pat has served as the director of another center at Villanova, the Innovation, Creativity, and Entrepreneurship Center. So it's nice to have a center director move up to the deanship. So that's hopefully be helpful for us. Yeah. Right. So that's one good piece of news. Also, just to kind of give you just a very brief overview, during the past year it's been a very active one for the Center for Business Analytics. We have had numerous speakers in, a couple of CEOs from Wawa and SAP have spoken. We've had a couple of other talks on marketing loyalty and social media analytics. So we've had a very heavy speaking group. We've run another roundtable in the fall. The school has launched a new minor in business analytics, and we've had a pretty strong student support of that already. Just launched it in the spring, and over 40 students, sophomore students, registered for it already, which is pretty gratifying. We are revising and have implemented a new curriculum in the quantitative aspect of business education, which involves a new course in analytics that all undergraduate students will take. At the graduate level, we've been running a whole range of analytics electives as part of the MBA program, and we will have offering a concentration in analytics within the next 6 months, I hope. I don't think there'll be any much problem there. We've also initiated a number of research projects with advisory council members, and obviously we're interested in working with you in joint projects, and these projects can involve students. And so we've initiated one now with PICO, with Mark Alden, who's on our advisory council here, and we're hoping to do others along that line as well. So if you have that sort of an interest, speak to Tom or myself about that. And with that brief intro, I'll turn it back over to Tom, who'll be your MC.
Okay, thanks, Matt. Just before we get started, just kind of picking up on what Matt said about the Center for Business Analytics, and we put some information in the packets at the table. We have the annual report of the center in there. And the center is really geared around 3 pillars. Okay? And the 3 pillars are curriculum, practice, and research. So that's really how we organize the center. We have an advisory council that provides, in addition to providing financial support to the center, also provides us with some great input into how we can expand and really leverage those three pillars of curriculum, practice, and research. And so I have the names of the people and the companies that are in the advisory council. You can take a look at that. If your firm is interested in learning more about the advisory council, just let us know. We can plug you in on that. And what I'm going to do is each of the speakers today kind of ties in a little bit with one of the 3 pillars. So the first one I'm going to talk about is our first speaker is Roland Moseman, who also happens to be on the advisory council. As I mentioned, the 3 pillars, curriculum, practice, and research. When the curriculum pillar, when we started the program, we started the courses, the analytics courses. Actually, Matt and I developed the first undergraduate one like 4 years ago. We used a simulation that Roland's firm had developed as part of the course material. We did that for a couple years. And actually, I think now a course in performance management, the MBA program, and again, we had a piece of that simulation in that course. So that's really a great linkage, if you will, of the business community and the curriculum, and that was driven by the advisory council. And that's the type of stuff that we get from the advisory council in terms of running the center. I'm really appreciative of that. Our first speaker is Roland Moseman, and I've known Roland for, I guess, 5-6 years in a variety of different points of intersection. Roland was involved in analytics before it was called analytics, and he'll probably touch on that. So back to business intelligence, he's been involved in kind of in that field for at least 10 or 15 years, I guess, as a practitioner. He has an undergraduate degree from the London School of Economics, where he was actually a classmate of Michael Lewis, the author of Moneyball and Big Short. He has an MBA from Wharton, and he also spent some time working as a consultant for McKinsey. And as I said, he's kind of earned his stripes as being a thought leader in performance management. He's written a couple books about performance management, including the latest one, which is called Performance Management. Currently is the CEO of AlignAlyitcs, which is involved in kind of integrating companies' existing processes into performance management. Does a lot of work with IBM, and before that with Cognos. Travels all over the world, consulting and speaking. And it's really my great pleasure to introduce Roland Moseman today.
This work? Yeah. There we go. That sounds good, because I think my voice can project without it, so I don't know if does that work? Speaker better? Good? All right. I'll have to move around here. Well, first of all, it's a great pleasure to be here. As Tom said, I got sort of connected to Villanova about 5 years ago when they were starting to look at this program around analytics, and I was sharing with them some of the things we're doing around this business simulation, which he mentioned, and it was just great to be invited at the ground floor to think about how to help kind of develop those three pillars. And from a practitioner's point of view, we see it time and time again, the gap in skills around analytics, analytic thinking, problem-solving techniques are really growing exponentially. And I think studies have been quoted that I think we talked about last time in our council meeting, that the gap is getting bigger. So the things that are happening here, I think, are really relevant to any one of us who are kind of in this space. So I'm just going to give you a little bit of a kind of connect point between what I'm about to show you and my background. I got involved in this in the early 90s, and I had come from some experiences that had sort of big concepts and also a lot of analytics. I had spent time with McKinsey, as he mentioned, and it occurred to me the first time I met sort of business intelligence, I saw it, which was early stage, that here was an interesting answer to what I had experienced as a very expensive human data processor. As a sort of first 2 or 3 year consultant, you do a lot of data collection, you do a lot of data management and data mashing, and then you do a lot of data presentation. And in the end, you produce some pretty good analytics, and people will usually get insights. It's just a very, very expensive way of doing it. And it occurred to me that if you could embed that type of process into the technology, then you could create a very sustainable value. And I thought that was just around the corner. That was 95. And so the good news is it wasn't around the corner, and we learned a lot of mistakes during those years. But now the good news is that the market is really more mature now than it was then. The technology is much more capable, and as I mentioned, the need has gotten much greater. So a lot of what you're going to see here is the sort of result of years of trying to make some of these bigger concepts around value of analytics and a strategic and enterprise view of analytics, to make those work, and coming up against the challenges to do so, and then coming up with various techniques and frameworks and tools and concepts to try and facilitate that. And so I think my session will be more of the sort of design and concept session, and then we'll have a chance to see some practical applications of what companies have done, and then at the end, sort of the new future around mobile. So I think it's a nice bookend for you. I'm going to see it better from here, so. Too many mics up here. So I usually start with this by saying, all of us have been hearing more and more about analytics. I think this turnout today is an example of that. There's much more input, much more validation around the sort of strategic value of analytics. It's exciting. There's lots of great written material about it. We've all, Davenport came here and spoke. We've heard him. It's an exciting time. And I think the punchline is that it's becoming more accepted that this is a strategic capability. It's not just a project reporting kind of initiative. These are things that can make you as a company outperform. And in fact, research is starting to back that up. This is a study that IBM and MIT did recently, which was a follow-on on a previous study. And it shows that companies that have more analytic capability tend to outperform their peers. And there's all kinds of other factors that they talk about in there. But at the end of the day, to me, it's about agility. It's about course correction. It's about being able to make quick changes because you have better information to do so. So that's the promise, and that's the exciting stuff. This is kind of the practice. And I might be a little bit provocative here, but McKinsey study from a few years ago, 60% of executives say they make good decisions that often is bad. That's a coin toss result. And the Bain study about IT investments, in this case they were talking a lot about analytics and major information in investments, that it has a very low success rate, at least perceived success rate. So this is the reality. We've got a great promise, and then we have a lot of skepticism for most companies. How do you actually get there? How do you measure the value and so forth? So if you look a little bit at what are the typical challenges that prevent you from getting the value, they tend to be, I mean, there's lots of challenges, and certainly technology and data are big challenges, but by and large, that's not really where the problem is. The problem tends to be more organizational challenges. Lack of understanding of what analytics really is. We keep seeing that. How is analytics really that different from what I do in an Access database with some smart guys? And in some ways it isn't different, but the opportunity to be a strategic capability is a big difference. So getting management to kind of weigh the opportunities and set priorities around it. So these are sort of things that we as a company focus on, and that's partly why our name talks about alignment. How do you get better alignment around the value of analytics? So part of what I'm going to talk about then is how this framework that we've developed over the years, and the book sort of describes, is one way of getting better alignment, and how that framework helps you connect sort of top-down, bottom-up metrics and drivers, and then understand some of the key elements. So I'm going to try and walk you through a core component of that, which is a concept of a decision area. And simply put, decisions drive outcomes. So if we can understand decisions and where they fit, then we can understand the outcomes we're trying to drive and affect, and we can understand the information we need to support those decisions. And then I'll sort of show the connection between top and bottom, and then I'll flesh out some concepts, and if we have time, because I know we've got tight bell-keeping timekeepers here, we'll see if I have some examples I can pull from this business simulation, which in some ways illustrates these concepts in a hands-on way. So at the core of this performance management framework is sort of a concept of a decision-making process. And it's anchored around three core questions. And it's applicable to anybody in the company. And the next question is, how do you actually collaborate around those? So, how are we doing as your starting point for most management reviews and sessions compared with where we were, what our plan was, how are we doing? So these are your scorecards and then sort of things. Why? What's going on? What's the variance? Can we explain it? What should we be doing? So that's very simple in principle, but if you can tie those things together in a very seamless way, then you can actually be much quicker about making decisions and adjusting. So putting that in the framework, and this up in the left-hand corner is a book cover, the cover of the book, and inside it is this visual, which basically says if you think about the organization, every part of the organization is trying to address those three things, and each one of those can be supported by certain core capabilities in terms of technology and in terms of data. So, how are we doing? This tends to be measuring and monitoring type of technology, scorecards, dashboards, alerts, those sort of things. Why? That tends to be more analytic cubes, reporting, maybe some deeper advanced analytics or analysis capabilities. And then planning and predictive forecasting is going to be, how do I now figure out where to go next? And I remember back in my business school days, we had this professor who taught, I think, the history of management thinking, or it's some sort of obscure title, but he was sort of reflecting the whole span And he had this one analogy which I always liked, which I think reflects this, which was that, you know, if you were on those big battleships in World War II and you shifted your guns towards your target, you never really expected to hit the target the first time. It's all about trying to calibrate by shooting a couple and then figuring out where you're going to aim. And that's, I think, the same concept with planning and with predictive analytics and with any kind of scenario analysis. You've got to take a shot to figure out how to better aim that shot. And that's part of the kind of capabilities of the new technologies. So if you drill down on these different functions that each have different decisions they're responsible for, we illustrate in the book some common areas of decision making. We call them decision areas. No big surprise. And each of these then represents things that you would be doing in that function. Now, this is a sort of generic overview. Obviously, each company has different labels for their departments and functions and capabilities, but fundamentally things that you would be doing as part of your responsibilities. And for each of these, if I look at demand generation here in the marketing function, you could sort of identify the kinds of information that would support making and understanding what's going on, making decisions and understanding what's going on in demand generation. So in this illustration, there's certain goals we've been given. We've got to drive incremental sales on top of baseline sales. We want to try and get a high ROI in our promotions or marketing spend. And to the right of that then are certain metrics that will help us understand and analyze what those goals, why those goals are performing or not performing, and importantly what the context is, the dimensions. You know, what am I looking at? By what perspective? Is it what region, what marketing campaign, what sales territory? That dimensional side of it is a critical piece of being able to structure a good analytic environment. So if I take these things back up again and I look at it not from a functional view but from a kind of high-level enterprise view, you can think of these things as supporting. This is in some ways a derived flavor of the balanced scorecard. It's at the top end you got financial management, which is essentially trying to manage and achieve the best value in terms of your existing financial results. So that goes to the way you report, how accurate you are in those things, but also how well you can explain things from the financial perspective. By the time the data gets to that, however, it's all long gone. So you want to try and look at more leading indicators, and revenue management, expense management represents operational data that you would be able to analyze and look into to extend, so to speak, your line of sight. So what's really driving revenue that will affect my financial results a quarter from now or a period from now. So revenue and expense I kind of see as this balancing act, that you can do certain things and really accelerate revenue, but if you're not careful, you can come off kilter and affect some of your expenses. And likewise, you can cut expenses and be really tight, but it may affect your revenue. So that's a constant balancing act that management has to do. But it sort of exists in the short to medium term environment. The longer term environment is what you're doing to make investments, strategic investments into core capabilities and long-term assets. Those are the ones that will affect how you do those revenue expense things in the future. So that kind of is a perspective of the kind of the framework that we put together. So you've got a functional view, which is sort of a bottom-up view. You have an enterprise view, which is how things fit at the top. So I'm going to go from that conceptual to something a little bit more sort of specific in the connecting the dots storyline. So I'm going to take that top-down view again. So the financial management, which you had at the top, you can break down into your common core metrics or goals that you're managing around. Growth, margin, asset efficiency. You can add risk and kind of sort of control type of capabilities around your assets. And then you might drill down on those and look at certain critical information that you would have or hope to have in your financial toolkit. Variances around cost of goods sold and SG&A, your working capital ratios, sales plan variance, and volume and price variance around revenue growth. So critical things that a FP&A group, a financial planning and analyst group might be looking at to figure out what happened. But to go beyond that, to really understand what's likely to happen, they need to get down to these operational drivers. And now we're looking at each of these branches. So as I said, shorter to medium term revenue and expense. On the revenue driver side, you're going to be looking at things like the overall value of the markets you're in. You know, are you in the right markets? What's the upside of these markets? Are there other markets you should be in? Are there other markets that your competitors are in? So that's the more strategic view around where revenue is going to come from over time. given the markets you're in, how are you actually acquiring your customers? You know, are you effective at that? Are you measuring that well? And given that you now have the customers and you're managing those, are you retaining them and retaining the right ones? And what's that cost you? And the bookend of that is, what's the realized value? You go into a market with a certain assumption around sort of contribution and overall you know, value of that market. Do you actually get that at the end of it? So each of these represents kind of common sense discussions around what would be a drill down structure that I'd like to be able to have to understand what's driving my revenue, my expense, my assets, utilization, and value. So if I now take those two concepts together, and at the bottom here I have the color-coded functional decision areas that I mentioned earlier. So under each of these, there are certain decisions that I'm making around demand generation or sales tactics, but that kind of fit under one of these branches, one of these core drivers. So conceptually here, I'm saying, if I'm looking at the markets I'm in, I've got to understand the opportunities around growth, share, you know, market revenue, margin. I'm going to understand my competitive environment. I need to understand how our product and portfolio fit in there, and ideally have good market and customer feedback to understand if this is the right markets to be in. You'll see that the color-coded functions also illustrate the fact that to drive good results in this, I'm going to need to have some collaboration between different functions, or I'll be doing different things without knowing what the left hand or the right hand is doing. So a common silo problem is that you solve an analytic problem for one function, but you don't necessarily look at it across 2 or 3 functions that in fact share in some of these drivers that affect your value. You can extend that sort of framework to the external vision as well. So I put in the middle in the white there the core framework internally, but around it you then have, you know, strategic events that happen, you have compliance that affects you, you've got environmental things that happen to you. So if you're looking at risk, you kind of look at risk in 2 ways. What are the external risks? And many will say, well, I can't do anything about that. But then you need to look at the internal capacity and processes that you have for dealing with those risks. And it's usually that where the analytics come in. Do I have scenarios I can run against worst case situations? Do I have contingencies? Have I measured the cost benefit of those? So having that external and internal perspective and using it in how you look at data and how you look at analytics is kind of the principle here. So bringing that all together, what we use our decision areas in the framework for is a way to connect a lot of moving parts. And one of the challenges when you're trying to achieve greater alignment is to see how things fit together. So if I look sort of at a functional agenda that each of the different functions as well as the executive management may have and connect it to those decision areas, if I look at the strategic agenda we may have and look at strategies, goals, objectives, and see how we connect those, I can get a pretty good sense of the kinds of metrics and information that would support execution there. We tend to think of that as the demand for information. And then we look at sort of a supply side, demand and supply, and try and figure out where the gaps are and the misbalances are. So on the supply side, we try to understand the organizational structure, processes and activities and applications. And then we combine that into a very simple concept, which is an information supply chain that we can map to discrete decisions. So the concept is simple. Where's the data coming from? What's being done to it? How's it being delivered? But that's where I'm going to be able to diagnose what some of the critical gaps are to prevent me from having good, powerful analytics. And if I can associate that to specific decision areas that have specific outcomes, I'm getting closer to kind of a cost benefit or a why am I investing in this piece of technology to drive this type of outcome. So that's kind of visualized here. If I can look at the top around strategic and financial goals, and I can understand the areas of decision making that are going to affect those, and I can understand the information supply chain that matches those, then I have a way to kind of prioritize and get alignment essentially around initiatives, whether they be strategic ones where I've got big investment and a lot of value, or if they are low-hanging fruit where I've got some pretty good value and they're not that hard to do and so forth. So trying to come up with some way of, and that's how we tend to use this framework and partly why we developed the framework. So let me touch on a couple of key concepts that that sort of underlie this. The notion of cascaded metrics. So I don't know if you've had this debate sort of internally at times, but how many KPIs are enough? How are too many? Or how do you create a KPI structure from a balanced scorecard where you have so many connections, right? How do you create that? So part of this is to sort of say, can we create a cascaded set of KPIs, and you can call them KPIs, you can call them metrics, you can really call them whatever you want. I think the important thing is to understand the causality tree that you're trying to reflect. So if you can create that causality and associate the right metrics to it, that's kind of the structure you want to have. And then the answer to how many KPIs are enough is it depends who's looking at them. So at the higher levels, you want the top level KPIs. As you come down the chain, you'll have those slices that match up against those functions. So it is actually organizationally quite a few KPIs, but for the audience, the eyeballs that are looking at them, you're trying to limit it to that structure. Context is king is a concept that it keeps coming back as being very important, which is understanding your dimensionality, because it's really the common language that you have. If you want to compare sales and new customer acquisition and customer retention, you need to make sure you got product, customer, geography well defined in a common way, otherwise you're not going to be able to have that conversation. So context is everything in terms of understanding and sharing. And then collaboration network is, who else is in that network that really should be getting the information or can contribute to that information. And then I'll give you some examples from our simulation where we kind of illustrate these things. So if I start again with this revenue side of the equation, the cascaded metrics, then I'm taking this from the simulation because they're all sort of tied together and I can show them to you. But basically, if we're looking at revenue growth in this case, and we go back to that structure, market opportunity, we're looking at metrics around size, growth, margin, divided then by the different combinations of those things, segments, geographies, products, and so forth. And we're looking at market share. And those two will drive a sense of revenue growth for a longer term. If I now drill down on market share, in this case we have two metrics in the simulation, something we call an inquiry rate, which is how many sort of leads, how many people ask us for a quote or ask us for inquire about our price and product. And then we have a win-loss ratio, which is how many of those do we convert. So pretty simple principle, but allows us to then to track things that are driving awareness in the market versus things that are driving effectiveness on the sales side. So if we drill down on those two, then in this model we have sort of underlying metrics that we can drill down on a cascaded way. So under the inquiry rate, we're looking at our relative price, we call price spread. We're looking at marketing spend by method. We're looking at customer service levels and some sort of history, customer value to date or something like that, to see if there's a loyalty factor in there. On the win-loss, we're looking at price again. We're looking at our sales priorities in our CRM system. We're looking at our product quality and how we rank in terms of product. And we're looking at sort of technical and marketing support. So again, just a structured way where we can start dividing the different cause and effects and start analyzing them separately and then bring them back up. From a context point of view, I mentioned this, but dimensionality is an easily confused topic, and there's different opinions on so many things around it. What we try and do is to create some sort of common business framework that you can use to understand your dimensions. So this is just an illustration of the concept, but think in terms of critical business anchors and other factors around the way you look at your business. So the business anchors are product, customer, location, transactions, and that will give you kind of your core function that ideally you want to try and have across as many of your processes as possible. Your financial dimensions are going to be things like financial accounts and lines, your organizations, your projects, your campaigns. And each of these you can start looking at and seeing how well the different data sources and functions fit in against those. So if I have good financial control and I've got good core anchor of my business, I can start looking at other things like resources or extended enterprise views, my suppliers, my distributors, and start constructing something like that. So again, that's the framework, but it starts with understanding the decisions that you're driving. I guess a few others here. Yeah, so we have the external market side, And then something that's not that well defined for most companies, but your core management processes around strategy, risk, other business processes that you might have defined that allow you to cross-reference the who is doing this, when are they doing it part of the equation. So lastly, I'm going to bring that to the collaboration network here. So across these things, we have different functions that are involved and different roles that are involved. So I'm going to illustrate this for market opportunities. You can think of the different functions and they can think of different roles of decision making. So put it very simply, executives, managers, analysts, professionals, and then you can think in terms of where this falls in terms of their job profile or their role. And that can then govern the kind of information, the kind of reports, and the kind of contribution you're looking for in that collaboration network. So some people may just need a status update. That might be a very simple dashboard, a very simple scorecard with a bit of information. Primary work tends to be that you're in that transaction flow or in that decision flow. So you probably need more information. You need to be able to query and do things around it. Contributor means you're adding something too. So if I'm looking at the market, I want to make sure I've got some information from the product development side around timing of new product entries, quality of new products, those sort of things, ranking of that. And again, this is just a principle or sort of concept. Obviously, for each company, you want to look at the specifics, but it does help you get past the silo thinking of I've got one function and they got one bit of information, and realize that there's a flow of that information across. This is an example of sales tactics, which tends to, you can argue, kind of go further afield because you got sales and finance deeply into it, and then all these other functions have some contributory role to it that would help as you're looking at that sort of how effective is my sales force, how well are they being utilized. So I might be going a little bit faster than planned. I know we're tight on time, so I've just got a few more slides here to talk about some examples, and then can open up for questions, and we'll take it from there. So a bit of word about our simulation. We developed a business simulation game effectively a few years ago to help illustrate and explain these concepts. And contrary to many simulation games, we tried to actually simulate individual transaction records. So we created individual transaction processes in the simulation across half a dozen or so functions. Sales orders, procurement, inventory, and then created discrete records for each transaction that we could then bubble up into a nice information layer and then create the different reports. So that meant that you can control the data very nicely, obviously, in the simulation, but you can create now examples of these reports all the way from a financial scorecard through all the different functions. And what I have next are a few examples of those, coupled with kind of a structure around the top-down that we also help model when we do these things. So just to kind of bring this back here, we've got a high-level view, line of business, division A, division B, within the performance areas, which are those different buckets: financial management, revenue management, expense management, and strategic asset management. If I drill down on financial management, I've got my core drivers: revenue growth, operating margin, asset efficiency, and risk exposure. And if I drill down on those, here's the decision areas that we had in the framework. So under the income statement decision area, I'd be looking at KPIs around actual versus plan, net sales, operating profit, etc. So this is my starting point. As I go from left to right, my drill down variance, or my sales plan variance, I would actually probably come to next, which is looking at where were the sales off, which territories, which markets, etc. And then my drill down variance, I'd be trying to look at combination of some financial data and some unit data, which is not always as well connected as you'd like, but so you can get that volume value mix and you can start understanding what's really driving that. It's not unusual for a variance analysis conversation to be sort of stuck in what was different from the plan as opposed to why is it different. So if you can get that root cause analysis going in the variance analysis, you got a better chance to adapt and change moving forward. And that's also a function of how hard it is to get to that data, of course. So in this example, the business simulation, we start the company off with an overall view of the P&L, which you then drill down on, and you have some key metrics that you explore. And the purpose of the sort of experience is to see what happened before and what you can do to modify things and ultimately achieve a better result. And In this case, the company drove the revenue from 113 million to 155 million, so that's a very good score for that team, and they improved the bottom line as well. So if we then look at the other side of some of the operational data, we've come down revenue management, we're looking at the market opportunity, and down here we're looking at things like overall company share, we're looking at market growth rates, market revenue, contribution or margin of those markets if we can. So in this example, in the simulation, you kind of look at a portfolio of your markets. And you have on the axes here, market share. You've got net margin as estimated by the finance team. And then the size of the bubble is the size of the market. So as you're looking at the different combinations you're given, and in a simulation, life is simpler than in real life. So you've got 9 combinations. You've got a North America, Europe, and Asia geography, and you've got a high, medium, low market segment. So as you're looking at these things, you obviously have the higher markets are getting higher margins, but your key decisions is, here's a very big market in Asia, can I push that up by a few percentage points and get high volume and really drive better utilization of a lot of my manufacturing equipment and so forth? Or should I be focusing on the markets that have really high margin and where I have a higher market share? So you end up essentially with a classic Porter choice. Do I want to be a cost leader? Do I want to be a product differentiated player? And if so, how do I modify other decisions around pricing, around product, and so forth? So then if I go further down, I've now identified the markets I'm in, and now I want to look at how well I'm actually driving sales. Then in the demand generation exercise, you end up analyzing how much you're spending, so you can see you've increased a lot of spending. You can look at it by geography. And then down there, you're starting to figure out the return on investment of that spending. So what's the best value per dollar spent in terms of leads that we can generate? And again, we're just bringing in different dimensions, but they're all connected, so the geography and the leads are tied to the right products and so forth. And the last one then is, I've got demand coming in, how am I executing on the sales side? How effectively are we doing that? And now we're drilling down on those 2 other elements, so I know what my regional sales are, what my product sales are. Now let me drill down on these 2 other metrics, my inquiry rate and my win-loss rate. In this game, the blue represents 2012, so this team did relatively well across most of their combinations in driving new inquiries, but they did less well in converting them into sales, so they've lost ground in some of the markets or just held even. So there's still a sales effectiveness improvement to make for this team. And the last thing I want to show you was how you can take the same concept and kind of structure a strategic view of things. So we've in this case, we take the same simulated company. They're called FutureChip. We've got the 2 divisions. So the first division is really focusing on high growth, doubling revenue in 3 years, and a very product differentiated strategy. So in terms of their goal, double growth strategy, achieve leadership position in high value markets, gain product innovation leadership, create high value brand awareness, foster value added consultative selling, deliver outstanding customer service, and improve customer profitability. So those were specific strategies that they laid out, and for each of them they set certain objectives that were needed to achieve that strategy. So to foster value added consultative selling, create high touch relationships, provide high value products, provides solution design expertise, and raise the sales team's product knowledge. And in this example that I'm just taking another example of how that can then be turned into a metric structure that you could begin measuring over time and saying, how are we doing in these areas? What are we tracking? And one of the disconnects we see with a lot of companies is tying that strategic plan to something that it has metrics that are being tracked on a quarterly basis. You have an annual process, you define the plan, you review it again from time to time, but other than the highest level goals, the things that are underneath tend to be hard to track on a regular basis or to tie back to your quarterly reviews and your operational plan versus actual discussions. So that's it for the overview of the performance management framework. Any questions I can answer or any clarifications on anything I showed you?
No, go ahead.
A lot of the research shows that
corporate culture is one of the main reasons why analytics initiatives aren't successful. I was really interested in your collaboration network slides there, and was wondering, when you work with organizations to go through that, and those are produced, does that really like turn, get people's eyes open to say, wow, I'm really not in a silo, that I really am working with a lot of other groups, and therefore that really helps with the corporate culture and understanding how these processes work, and then that also just builds up the success.
It does, and it gets the conversation started. It doesn't solve the problem, because you still need incentives to change. You still need, the way management looks at it to change. So it's usually part of a larger initiative or change management. You want to ideally, we often run these programs with a combination of those silo represented plus some executive level, so that they can all kind of see it and engage in the conversation. You can start tracking some of these metrics even if they're not part of the incentives. That's a sort of backdoor way of getting that going.
I had a couple questions.
Sure.
If we have time. So thank you for presenting. I saw in the where the data collection process came from. How do you incorporate some of the emerging technology analytics that we get, like for example from social media? I know we're talking about mobile later. Yep. But getting that insights and incorporating that into the decision tree.
So if you look at the, and obviously these things are meant to evolve and be adapted to each customer environment, but basically this is where you're trying to capture more of that. I mean, historically, marketing customer feedback was more manually driven. Sales reps would provide feedback, customer service people provide feedback. We now have the opportunity with big data and the social media to create a whole series of other data sources to support that, which wasn't there before. So part of that is obviously the technology to gather that, but then the way you tag that, the dimensions that you can create around that would then either match up against or maybe even begin influencing the other ways you categorize those customers in your other areas. You also have a chance on the customer service side where you're looking at basically information about customers and service benchmarks to tie that in. So you can look at different places where the customer's voice would want to be looked at in the context of what you're trying to achieve as a company.
All right. My second question was, a lot of the KPIs seem to be around the financial, because because we all have sales targets to hit. What about setting KPIs, or how do you do that in cases where we want to mitigate risk? So let's say like a recall or some sort of issue that we have. It hasn't happened yet, so we can't put a KPI tied to financials. But how do you incorporate that?
So we look at risk as sort of the flip side. Risk and performance are flip sides of the same thing in many cases, and the difference tends to be the threshold you put on it. So for a performance, I'm trying to look at an upward threshold, and it's usually around a manageable goal for the execution. I take that same value and I look at a threshold on the downside that represents what would be unacceptable and intolerable, and I create contingencies for that. So if I'm looking at information complaints and claims, and I've got complaints, counter complaints, I've got failed orders, I've got returned units. Those represents a metric that can become a customer service scorecard, but it can also become something that ultimately affects reputational risk, that ultimately affects major recalls. So you can create a series of connections from that. And there are certainly times where the risk name, you may want to change the metric to fit a certain message you're giving, but conceptually these things tend to, you're looking at risks that you can manage internally through the actions you take.
Okay, all right, thank you.
Yeah, Roland, thanks. Very interesting presentation. Question that I have kind of follows on the first one. Could you describe what I would call the value proposition for AlignAlyitcs? In other words, I'm a Fortune 300 company. I got an ERP. I'm trying to look at the right analytics. I don't know. I need to improve management. I mean, is it an awareness? Is it a simulation? How do you modify the decisions? how does this fit on top of, you know, all the software that all companies have got right now?
I have one slide to try and visualize it, and then I'll explain it in a second. So this is kind of how we visualize it. Many companies, it's hard to get a full view of the company. There's so many different moving parts. So strategy, regulations, policy, systems. What we try and do is to basically create structure around that you can then act on. So we do that through a series of frameworks that we have tools to manage, so you can model your business around strategy, around process, around key performance objectives. You can model your business around the organization and process structure that matches. You can model your information capabilities around assets and supply chains. So we create basically a model of your business that does this, and then allows you to do analysis around that, communication, analysis. Then the simulation is essentially a way more of a change management role. It gets people to get a shared vision. We use it sort of in two sides. On the front end of a conversation as a shared vision, this is what it would be like to have great analytics. This is where we want to get to. And then on the back end, how do we actually ensure adoption? We've built some great stuff. We have a lot of great information, but people are still pulling stuff down and putting it in Excel and doing their own thing because that's what they've always done. And that's not wrong because they have a lot of skills there, but how do we now show them that with this capability we can amplify those skills and create much higher value for the company? So that's how we use the simulation. In the middle, we tend to use this framework and tools to help create a roadmap, sort of a vision and a strategy roadmap, and then start looking at some quick wins to get validation around what you're doing. We don't do implementations of technology. It's more kind of around those softer skills or challenges that exist in doing this.
Could you do load real transactional information in for that to simulate the real situation, or is it a simulation of your?
The simulation is a separate structured simulation. It would be too complicated to create sort of that would be a nice thing to develop in the future, but it's not. But what we do is we do identify some of the early analytic sort of nuggets and create some really powerful proof points with a strong analytic team with you to say, this is, so to put it very simply, we look at this sort of as a continuous life cycle. The first part is, do we have a shared vision? The second part is, do we have a roadmap for getting there? So the vision gets you excited, roadmap brings you back down to earth. Then we need to kind of get people excited again, so let's pick something that we can do an insight that has clear value, and then we come back and make sure we can realize that value, so we keep kind of supporting those things.
I'm interested in the analytics around resources. Obviously a problem is budgeting and financial constraints, and not just single period, but multi period. And if you have a collaboration model, that's where things get a little bit sticky, right? The people want more resources, things like that. They don't want the resources cut. Right. What do you do there?
Well, the problem exists, right? And the problem exists in these matrix organizations. And the first step towards addressing that problem is recognizing the order of magnitude of it, right? So if you can start identifying the non-core job activities that a certain role has and begin kind of listing them, categorizing them, putting them in the context of why are they doing those things? Well, they're related to these things over here. So we start by trying to get a clear map of what's going on. Then we can overlay some sense of order of magnitude of time. We try and do a lot of things kind of based on the common conversation and order of magnitude before we go and try and quantify absolutely everything, because that can be a very labor-intensive exercise. But just get an order of magnitude where you start saying, well, we clearly have, I don't know if you've seen these kind of LinkedIn maps, spider maps of different relationships that exist. We're trying to get something like that ourselves, but you can picture when you put these relationships of job functions and roles and core work, but then this related collaborative work, you start seeing sort of centers and bigger, thicker lines, and eventually you'll say, well, we have a very high demand on this set of people or roles or categories. And I think that's part of it, is to help visualize what's actually happening and then start putting in some order of magnitude around that. how do you actually solve that, I think, still has to go back to the company saying, how are we going to adjust for the fact that we're putting a lot of workload on this particular set of collaboration, but we're not necessarily recognizing it in the way we organize comp plans and incentives and so forth. I don't know if that answers your question. I guess what I'm saying is the challenges here are not trivial, and what we're doing here is not meant to be some silver bullet, but it's a starting point to get a shared view of what's actually going on, that you can then start having some of the conversations if you really want to get to that vision.
Thanks, Roland. With your clients, is there a typical calibration period before you got a reasonable level of confidence in the simulations that you're presenting back? One of the downsides of the production of graphs and charts is typically senior executives see what you react, and then that becomes gospel as opposed to considering it as a vector range of possibility, right?
Yeah, I think that's a very valid point. I would say it's at least got to be four quarters, ideally 6 quarters, to start building up confidence. I think there's a lot of benefit of using it during those 4 quarters and 6 quarters to figure out what, the best way to learn and have confidence is to make assumptions and test them. So you've got that time to do it. We're working in a project now where the CFO and CEO are looking to extend the guidance they give to the street. This is an industry where they typically only give a quarter's guidance, and they want to give up to a year. They believe that that's going to significantly enhance their share price because they think they have a very good strategy. If they can communicate that vision clearly and say, this vision is going to get us to this level 4 quarters from now, they're going to have an impact. To do that, they've given themselves a year to get there, which I think is tight. And they're right now looking at the critical driver models and trying to understand what are the metrics they need. They're looking at their forecasting process to see how they might change that. They have one of the big consultants in there, Bain, doing a lot of analysis. We're trying to capture that and say, let's make sure we can actually structure that in a way that works in your existing tools and in your environment. I suspect that they do rolling forecasts, so it's a bit easier. They do a weekly forecast, week forecast, so they will have a lot of data points even if they only get this in place sort of with 2 quarters to go. Okay. I think we're close to.
Well, when you mentioned it, when you got involved in this, before it was called analytics, mid-90s, and you thought it was going to happen within a couple of years, right? Now it's benefit of a couple of decades of hindsight. What do you think some of the obstacles are to companies really embracing analytics? I mean, a lot of them do, right? Compete on analytics, but we thought at the beginning there was a big gap now between companies that use analytics and other businesses that don't. What do you think some of the reasons are why companies haven't embraced that?
I think there's several of them. I'm not sure I would necessarily rank them, but I know I used to say 10, 15 years ago that one of the biggest challenges was that the executive teams that would ultimately need to play a role here were so uncomfortable with technology. Well, that problem is growing away, literally, right? Most of the new executives are fully comfortable, and that's not going to be an issue. But the change management, I think, is still the biggest challenge, because the way you run a business with much greater visibility around information is going to mean a lot of change to how people do things. And I think that's a legitimate question, because you don't want to disrupt something that works. You've got people who've got very good kind of innate gut skills, and how do you blend that? And so I think the challenge is going to be that taking the risk to do something different and make that organization change. And I think coupled with that is that I think there is a lot of cynicism in the industry around the latest technology thing, right? So you've changed the name to business analytics. I thought I heard the same things from you a few years ago when it was business intelligence, and before that it was decision support or whatever, right? So there is some built-in cynicisms about prove it to me. So I think you need to think about these things as, how do I build credibility, because I still have to earn some of that back in terms of the latest, greatest, next thing. I think the vendors that are out there are, that their job is always to promise something ahead of where it is, and I think so. Be wary. There's still a lot of stuff to do to get there, but I think the good news is the technology and the data is certainly no longer the big problem, right? You have much more data now than you even know how to handle. So you've got a lot of data to work with.
Anybody else have any questions for Roland? Roland, we appreciate you coming. And we have